Mahesh, thanks so much for joining in today. We will get to the fun and the performance and a lot of other things, but I can't help but start talking about the way the commodities have moved in the last maybe 5 or 6 odd sessions globally, and the impact that it has had on a lot of these sectors as well. What are your thoughts? I mean, the market has moved along with it. Is this a bit of a dead cat bounce that is happening, or could there be something more constructive here?
Yeah, I think if you look at commodities have been severely oversold in the last 2-3 months, especially after concerns about China growth started to come in. And this was the second round of commodity decline what we saw in the last 2 or 3 months. And I think globally we have seen some kind of a risk taking back risk on kind of a scenario, and as a result we have seen some bounce back in the commodity prices, but we don't believe it is sustainable. We think commodities are structurally in a downtrend, and when they are oversold, you could see some kind of a bounce back. Even stocks, for that matter, if you look at a lot of the domestic stocks, have been pretty well oversold, and they didn't participate in the rally also initially. So given the obviously there is value if you look at from a price to book value multiples, or even from a asset valuation. But doesn't look like you will see any strong demand for commodities in the medium term. So given that, I think wouldn't one really want to play this small trade really, and I think in India specifically, if you look at a lot of the commodity companies, I think the challenges there are others. I mean, in terms of availability of raw material and other issues. If those issues get resolved and we see some of the things, and then probably you could see some upside in some of the domestic commodity companies.
So you don't have any exposure to metals, you're saying?
No, we have, but we don't have a large. We are underweight, been underweight metals for quite some time, and I think we'll continue to do that.
Okay, let's look at a sectoral exposure. I have the latest fact sheet with me. 29%, probably 30% in financials. You've got a large exposure to autos and slightly underweight exposure to healthcare. Financials is the key. It is only for benchmarking purposes?
No, so financials, yeah, I mean, agreed that in the near term, I think they have underperformed a bit. But we believe that over a medium term, longer term financials, as the economy recovers, you should see that sector doing well. And our focus weightage has been mainly in the private sector banks, and more I think banks which have got a larger retail exposure rather than the corporate exposure. And that segment has been actually growing pretty well. So we have, while overall credit growth would be around 13% or so, 12-13%, but if you look at the retail growth has been much stronger at around 18-20%.
Is it time to switch that trade? Is it time now? You know, we always look at PSU banks and private banks, but the way I look at the banking sector is let's look at corporate banks and retail banks.
Right.
Rate cut has kicked in, demand will come back, capacity utilization will pick up. So is it time to kiss goodbye to retail banks which are expensive and revisit corporate banks? I mean, ICICI Bank also is a corporate bank, let's be very real here.
Right. No, so I think, see, if you look at rate cut which has happened, so we have seen 50 basis point rate cut, and till now we have seen more than 100 basis point kind of a rate cut. Whether that would really resolve the woes of some of the corporates which are highly leveraged, I don't think so. And whereas the sensitivity for the rate cut on the retail side in terms of retail loans or auto loans, I think would be much larger over there. So, see, I think the NPA concern, this thing would be more a function of how the revival in the economy happens, how the policies are, and that would still take some more time and more effort, okay, in certain areas. So, I think given these factors, I don't think we will want to shift our focus on some of the retail plays. Agreed, I think the valuations also come into play really. So, some of these bank stocks having corporate exposure have been beaten down, their multiples are now lower. So, selectively I think, yeah, we are looking at some of those areas also where we have got reasonable comfort and trying to play the recovery in the overall corporate cycle.
Do you also have exposure to housing finance companies, because hopes are really pinned on recovery in them as well?
Yeah, so we've been again, housing finance is one sector where especially on the NBFC side where we have been pretty positive, and this is a sector which has again shown a steady growth despite the kind of a slowdown in the housing market, real estate market. I think the loan growth in some of these companies has been still pretty good, and we've seen that while we haven't seen any major concern on the real estate side, but still there have been some pockets. Despite that, we haven't seen any increase in the NPA levels over there. And I think in India, housing demand itself would remain a very long-term structural growth story, and the cut in interest rates also should help, right? So given all these factors, yeah, we would think that the sector again looks pretty good, more from a structural long-term
That's the
perspective.
safest collateral. that
Yeah,
one can
that's
get.
right.
Yeah, the other, I'm again looking at your fact sheet, and the other sector where you have a high exposure is technology, 13.5% if I'm not wrong in your benchmark fund. Now, what's the thought here? There have been a couple of company warnings that have come in. Some of those stocks have corrected quite a bit, and I read 2 or 3 reports, the sell-side brokerages, which are speaking about how the next 12 to 24 months may actually not be that great for Indian IT companies because of automation taking center stage in the US and a few other places. What is the thought here? What's the base rationale in technology?
So IT, we are neutral-ish. I mean, it's in line with the benchmark weightage. So we believe that the sector offers a decent upside. It's not a great upside in the sector. I think overall the sector growth rate around 13% or so, I think should be met. We don't see much of a challenge. Broadly, we are not seeing any major concern in terms of the IT spending coming down. Agreeably, I think what he said, the shift towards technology and digital is changing the way the business has been given out, and companies which are able to adapt to that, that shift, I think should do better in this kind of a thing, and that's where our focus is within the portfolio. And overall, I think the sector should show a reasonable growth around 14%, 13 to 15% kind of a growth is what we expect, which is quite okay in the current environment where overall earnings growth is still going to be pretty muted, probably in the low teens or so. So I think the sector offers a reasonable upside, which is falling in line with our view that the market should also give more or less not very high returns.
Why do you think markets will not give very high returns? Because what we are staring at beginning of a new cycle, aren't we?
Yes.
Rate cut, low commodity prices, government reforms. I put 3 things together. That means a new economic cycle is about to start. If a new economic cycle is indeed about to start with the general consensus, market returns have to be grand and disproportionate.
So when I say market returns will not be great, we can compare it to what we saw last fiscal year, okay, when the returns
that was
were
an outlier.
Yeah. So I think the market returns would be above the average returns what we have seen in the last decade or so. I think that our premise has been, and we believe that. So which puts it somewhere around 15 to 20% in that range. In that kind of environment, I think companies are earning, companies which offer a reasonable kind of a growth in that period and with lower downside. In IT, we don't see any major risk. While we have seen some kind of a profit warning from one player, so we don't think it's a systemic problem. And that the risk reward, the valuations in the sector are okay. They are not really very, very expensive. And there's some tailwind we have seen recently because of the rupee depreciation also, which should help. It's not been too much. I think some of that gains has been retraced a bit, but still there's enough cushion to support the earnings. So we are pretty comfortable on the earnings visibility in that sector.
So you don't expect volatility this month because it's going to be extremely crucial. You've got a Fed meet, you've got earnings as well to deal with. You think it's going to be a stable one?
So I think this, to a lot of extent, the concerns what we were looking at, whether it's the Fed increase on the global side, we've seen that play out to a large extent. We saw a large amount of volatility in the last couple of months or so. So given that, I think a lot of, even for that matter, the quarterly numbers which are expected now coming in, I mean, everybody expects the numbers to be not too great again in this quarter.
In the price, yeah.
So I think it is to a large extent there in the price, and I don't think you should see too much negative reaction to that. Even the Fed increase also, I mean, there have been talks about on and off, okay, how I think whether it could get delayed further. The recent data which came in suggests to us that the recovery in US is, again, at least the labor market hasn't been that great. So that leaves a lot of room that it might still get delayed. So given all these factors, I think we have seen the worst of the volatility is behind us, I would say. I think things should remain volatile, but not to that extent, and the market should try to consolidate around these levels. I don't see it moving up in a big way also, neither down, but should remain.
So you don't see a retest of the recent lows?
No, I don't think so. I don't think, because a lot of the domestic side, I would agree, as Nikunj was saying, that we should actually see, we have seen some positive data points coming, nothing too great actually, but we talked about resolution of the power sector. Okay, we could hear something more positive news coming in on that front. Some ordering starting to happen in a few sectors. In Bombay Metro, okay, we've seen the orders flow coming in. So I think those things are starting to trickle in a bit, and I think, and earnings side also, we think the worst for Indian, this thing will also be behind after this quarterly numbers.
So we've seen last 6 months, what have we seen? We've seen Greece, we've seen China, a rout in emerging market currencies, big yo-yo movement in emerging market debt, but your basic portfolio construct has not changed.
Yeah.
Why is that?
No, so I think our portfolio view, again, if you look at our portfolio, we've been pretty well balanced. So we never, because our belief was that a lot of the sectors are, if you look at what has happened in the recent days, there has been sector rotation which has been happening.
Yeah, so but your portfolio hasn't changed. I mean,
yeah, so we can't time those sector rotations because very short sector, I mean, we would like to play larger sectoral moves which will play out over the next 1 year or so. But the short moves which happen on a quarterly basis is difficult to play. So we continue to maintain our pro-domestic cyclical kind of a view and stick to that. And I think focus more on stocks. I mean, that's been a strategy in the last 6 months. I mean, last year, as I've been saying, we played more of the macro trades, but this time again, it is focused on individual stocks where earnings visibility growth.
The hero in this market actually have been the retail investors, the SIP money. Whatever foreigners have sold, domestic institutional investors have pretty much gobbled it up. What I want to understand from you is that on an average, how much industry is getting on a monthly basis? And what could be that aggregate number for the year?
So I think industry, what we see on average is somewhere around $1 billion. So roughly
Fresh
around
inflows.
Fresh inflows, yeah.
Okay.
Wow.
So that has been the average. In fact, this is the 17th month in a row we have seen positive flows into domestic mutual funds.
And what's your own corpus like as of date?
So our corpus on the equity side would be around 35,000 crores as of date. So which has almost trebled in the last 1.5 years or so. It's because of market movement also and because of the inflows what I see.
Has the stock picking style changed at all because of such a large increase in corpus? I mean, from 12 to 35 is quite strong.
No, I don't think so. I think the stock picking style will always remain the same. Okay, whatever the size of the corpus.
Maybe market caps, etc., would define.
Yeah,
some of that as well,
yeah.
Which
So
is what I was asking.
not necessarily. So we have seen flows across all spectrum of our funds, whether it's the mid caps, small caps, large caps, multi caps. It's been across. I mean, in the early part, it was more in the small and mid caps. But now we are seeing it moving across, like a lot of large cap funds are seeing good inflows at this point in time.
You know, call it a coincidence, a trend, but for the longest time FIs have been buying, DIs have been selling. Now FIs are selling, DIs have been buying. When will both these parties come on the same page?
Of buys.
So I think the domestic buying, I think, has been steady, and we've seen the worst of the kind of a turmoil of volatility what we have seen. So my sense is that should continue steadily, and as you rightly mentioned, a lot of money is coming through the SIP route. So I don't see much of a volatility over there, I think, and FIs, I think, won't stay away too much from the market. So what we've seen in the year till date, if you look at it, there's been huge selling across emerging markets. There's been 35 or almost like $55 billion of outflows. We've seen some negative outflows in the last couple of months or so, but year till date, we have still seen around $3.5 billion of inflows. And that selling looks to have kind of a slowed down. So my sense is that you should see as the global environment has volatility has normalized, and the sell-off in emerging markets has also come off to a bottom if you look at it. So given that, I think we should see the FI flows at least normalizing a bit in the next few months, and that's where I think you should see if that happens when you both have the FIs and domestic institutions also. The liquidity can play a big role in terms of how the market direction performs, and if we have some positive news coming, that could really take the multiples higher for the market without any meaningful change in the earnings outlook, I guess.
Sectorally, what could emerge as the dark horse this earnings this month?
Dark horse, very difficult to say because I think this month again you will see a lot of volatility in companies because of cross currency impact. Okay, what we've seen across commodity prices have gone down, so you don't know how it will impact individual companies because you could have inventory losses which could come in. So it's going to be a bit tricky, I would say, in terms of knowing the actual impact in which sectors. But so we are not really looking at it. I think pharma is one sector where company specific, I think you could see some strong earnings coming in this quarter.
The bigger ones?
Yeah, some of the bigger ones, even smaller names, even in the pharma, a lot of mid-cap pharma companies have actually have some interesting developments in terms of new products coming in, and one product can make a big difference.
Your definition of mid-cap is what? $1 billion company, $2 billion company?
So mid-cap definition now actually has gone up. So it's like now closer to around $3 billion, up to $3 billion.
See, that's the new mid-cap.
That's the new mid-cap.
That was the large capital about a year ago.
Yeah, so it'll be around $1 billion to around $3 billion is what.
Great.
Yeah.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.